Hi, my name is Felix Frey.
And I'm Marco Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. Options Geek LLC is not a broker-dealer. Options Geek LLC, Felix Frey, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode.
Hello.
Marco, how are you?
Good. How are you?
Good. Can you hear me okay?
Yes, I can. Looking at this market,
Right,
don't know what to think. Need some
Did
guidance.
Did you see this GME, by the way? What is going on? I don't even understand. There's no words to really understand what's actually happening there. But moves is the understatement, I guess, of the hour. Let's call it the hour. Okay, so what are we seeing out there? At the end of the day, we have something interesting going on in the macro space, the 10-year auction. We've been talking about bonds. There's been no bid for bonds in the last couple of months. Today, there's an auction. It looks like it didn't. I don't know. I mean, I'm just reading from the tape. Doesn't look like it went great, but it's starting to come back here. So the TLTs dropped a little bit. They're coming back. We'll see what the market does. But anything that's not a disaster should kind of hold the market. But the bonds being down, market took a step down. See how it trades going forward. One thing, there was an article I read yesterday that I thought was really good and slides and everything. And it's Gunlock. Gunlock is a big investor. Talks about, big into the bonds and the macro world. Actually two slides that I thought were really interesting was, what percentage of personal income in the United States is accounted for by the U.S. government? What would you think? Would you think what percent of the total U.S. personal income, so what everybody makes, is accounted for by the U.S. government?
70%.
Maybe people can guess. 70%. We don't live in Russia here. This isn't Russia. So socialism is like 100%. Okay.
Right.
Social Democrat, you would think. I thought it would be under 10. That's my guess. 27%. 27% of personal income in the United States is accounted for by the United States government. That's a big number. That's a pretty high number. I don't know what it's made up of. Whether it's food, food stamps, helps with food, whether it's, unemployment,
accounted for by the government gives to the people.
The government given to the people.
That was too high. Sorry. No.
Communism is like 100. Okay.
Yeah,
so it's incredible. I would have thought a small amount, under 10.
That's huge.
Even under 5. He has a slide there saying 27% of personal income, U.S. personal income, is provided by the U.S. government. The second slide, which I knew it was pretty big, but I didn't quite know the exact numbers. In 2009, during the financial crisis, the amount that the government laid out was $1.8 trillion. $1.8 trillion. Since the beginning of the pandemic, the government has laid out $6.1 trillion. So it's more than three times what we are. What we spent in 2009 in the crisis.
Wow. That doesn't include government employment, right? Just government giving out free money, essentially.
No, that includes everything. That includes the Federal Reserve issuing, helping states, helping people. That's just the federal government just making $6.1 trillion appear and saying, okay, here, take care of that, take care of this, take care of that. It's a lot of money. That's a lot. So I read that yesterday. I sent you the link so you can give it to people. I think it's a good read. It's a good pastime read. You want to understand what the big guys are thinking and how they are thinking about the world and where we're going and what we're doing. He also said, which I thought was interesting, we talk about me thinking about ideas and connecting the dots. He said the cheapest asset the cheapest asset out there, he thought was farmland. That's what he thought, farmland. Then I read an article that this was about a week and a half ago, that the largest farmland owner in the United States is Bill Gates. I don't know if you read that.
I know. Yeah.
That was it. So connecting the dots, you got a billionaire, you got this guy, Gunlock, talking about the cheapest asset. And then I had read the article, and when I popped up, I said, wait, what's going on here? Farmland. Right. Okay. So I thought all this stuff was pretty interesting. I then connect the third dot. China just announced that they bought, I forget, it's something, I think it's ethanol. They bought a ridiculous amount. They're like cornering the market in ethanol. They just bought, there's 5 U.S. carriers sending ethanol to China because they just bought billions and billions of dollars in ethanol. Ethanol is used, in farming and farmland. I don't know what's going on, and I don't know the chess pieces moving around, but connecting the dots, this is, we're starting to put something together and saying what's really happening, what behind the scenes, and where the billionaires actually putting their money. So anyway, I thought that's a good read. And we've been talking about bonds. We've been talking about the backdrop. We're talking about a lot of different things in the macro space. Maybe we'd even take a look. Maybe it's time to take a look at gold again. And gold has been unloved for a long time. But these are big numbers being thrown at us, and something that we should take a look at. That said, we're still looking. Everything is looking okay. Market's up. Apple is trading a little bit in the options, but they announced something negative. I guess they're just cutting some demand or production.
Yeah, there was this lowest tier of Apple iPhone that was not really as good as they thought popular it was going to be in terms of sales. Yes, so they're actually cutting that off. But Dan Ives, I read an article. He's very bullish on the stock. He's saying it's going to be a $3 trillion name.
$3 trillion.
Yes, and I actually went ahead and got long some stock. So I'm just saying what's going to happen.
It's probably never wrong to. I mean, it's never been wrong to get long a little bit of Apple on any pullback. It counts as one of those pullbacks. So we've come from 145 to 120. I saw today a little bit in Apple, people jumping in there on the negative news. You see in the Aprils, people nibbling at the 120s. It's very, very difficult to tell what's going on in Apple simply because the open interest is always so high in a lot of these names. But what I wanted to show you, I think, over the last couple of weeks, I've been getting emails that people want to see maybe outside of UOA, if I just wanted to get long a stock, is there a different way or a different approach to sort of use options? And I thought today might be a good one. So I would say, if you wanted to get long Apple, you can either buy the stock. I'll show you something. I'll show you a trade that I really like. This is a very, very good trade for the very conservative investor that might want to get long the stock. So you're someone that you want to get long maybe 100 shares of Apple. It's going to cost you $12,000, and you're buying the stock here at 120. The other way you can get long Apple is by doing something like, let's say if I wanted to go out to July, maybe June, July. I'll just pick July, middle of the summer. And I'm going to look at the chart here and say, okay, I want to get long Apple here. We'll just do a little bit of this. What's sort of the lines that stand out? I would say immediately, obviously the 145. There's a little bit of something going on here, right? There's something going on somewhere around here. Let's just call it 102.5, or maybe we can even say this one, but somewhere right around here. Let's call it 105. We'll just call it 105 just to throw it up there. You have, a couple of spots here, maybe this here too. This is sort of a level where, it did this push through here, came back down, but 137.5. And we're at 120 today. There's a gap here that, I always tell you to look for the gaps, and that gets you down at, like, say, 96. But usually if it would come down here, it should be relatively quick back up to sort of, keep the movement going here. So this is Apple. This is how I would look at it. So I'm thinking, I'd be a buyer somewhere around the 95, 105 area. That's where I'd be a buyer. It would probably lose a little bit of steam as it got to 145. People are looking at they're involved in Apple here. There's a lot of open interest in the we can just look over here. Apple open interest, 121. Let's just look at it from 120 to 150 or 160. Let's just see what we got. So we see the 125s in April is pretty significant. The 130s, 132s, 135s. So decent amount. Stock trades well. Stock trades a lot of volume. So you're going to see a lot bigger positions. There's also a lot of people that like overriding Apple. So we're never really sure if these are all buys or sells. But regardless of that, the stock is trading. The stock would probably pause, if you will, have a little trouble between 140 and 145. So I would look at so now, since we framed that, we're buyer near the 100 level, seller up near 145. We can look at the options board, and let's go back to Apple here. We can look at the option board where we're looking at maybe July's, and we could say, how do I get long Apple and reduce my risk? Everybody talks about options being risky. So let's try to look at something where I can reduce my risk and still be long Apple, and maybe get even a little bit of leverage. So I would look at, okay, I'm just going to look at the 125. We said 145, right around 145. Let's do the 150s. So the 125 to 125. Let's call it, the 125, 145. Okay, that's the high. 125, 145 is how much? So let's call it 285, 285 and 795. Yeah, so that's 510. Okay, so 510 for the 125, 145 call spread. And then let's look at the 110. Let's call it the 105 puts. What if we sold that at 390? 390. Okay.
So 120.
So net 120, right? $1.20. So for $1.20, instead of buying shares right now at 120.30, the stock is, look, it's not trading. This was not a strong stock right now. The stock is, you see the red lines going down. It wasn't that big of a pop here. You got some negative news out, maybe. It's not the most bullish stock right now. Not saying that it's not going up, but you got the 50-day moving average. You got a good 200-day right here, but maybe it gets down to 105. Okay, so you can buy the stock, or you can do this structure where you're basically selling the 105s, buying the 125, 145, and you're paying $1.20. Now, you would have to actually put up, it's like you're buying shares. So just like you bought the 100 shares, you'd have to put up 50% margin on these 105 puts. Okay, so you'd be putting up $5,250, half 50% of these puts. Okay, plus you'd have to pay for the $1.20 on the one lot, which is $120. So net, you're putting some money down on the table. It's like you're buying stock, but you've sold what's called the wings, the downside put and the upside call, to sort of reduce the middle part where you want to play. And the 125, for 125 to 145, that's $20. That's $20, and you own the stock at 100. So for $20, you can make a maximum of $20. Maximum $20. I'm sorry, the maximum that would be worth is $20. You paid $1.20, so you would make $18.80. So $18.80 divided by 120. $18.80 divided by 120 is 15.7 times your money. Leverage to the upside. To the downside, you own the stock like you would have owned the stock already. So it's sort of a way to, now it's not truly 15 times because you're actually putting some money down just like you did stock. But what you're doing is you're narrowing the range. You're narrowing the range of where, you're widening the range of where the risk lies. The risk is 120. You're going to be losing money from 120.30 below. This way, you're basically getting long the stock. You give yourself $15 of room in Apple. So that's about 12% down from where you are. That's a decent amount.
Right.
That's a decent amount. So you can buy the stock down 12% and still have this leverage to the upside, or you can buy the stock here and sort of play. You're in that middle ground where you're making and losing money up or down. These are trades that work very well with names that are down 25, 30%, usually that are thick names that have a lot of volume, that have a real business. I wouldn't do this on, your run of the mill, fantasy stock. But this is a solid name. If you want to get long, this is I'll call it a cheaper way of trying to get long Apple. So the July 105, 125, 145, they call it different names, but just, you can call it selling the put, buying the call spread. That's probably the easiest way to call it. So that's something to take a look at. So I like Apple in general, but I would say that I don't think it's the strongest stock on the board right now.
Right. Okay.
They also, the market also may be taking money out of Apple, right? They might be taking money out of Apple here. Apple was a safety stock over the last year. So what happens? You get this rotation out of names that were holding your money, and you take it out of that and say, okay, I'm going to buy the airlines. I'm going to buy the cruise stocks. I'm going to buy all these other different names. Okay.
Right. Okay.
All right, good. So that's what I would say. So I mean, I don't really have an opinion on Apple. I think it's a good stock, long term, but as far as options go in the near term, I have no idea.
Do you have any other examples, like something like this that we could do?
Yeah, I would say. I mean, look, I would say a good example. It does work for high stock, these fantasy names, and you have to really want to get long the stock. So something like Palantir trades a lot. Let's take a look at Palantir just to help you understand what you can get. Stock down from 45 down to 20 something, 23. A lot of options trading, so you have some friction both ways. Let's take a look at the same thing. Let's take a look at June. You get the earnings in May. Just to give you an idea how it works with a 100 vol name. It's going to look, I think they look pretty good, but you do run the risk that you're going to have to own the stock at a lower level. So I would look at something like stock trading 2477, call spread. I can look closer to at the money because I'm going to be selling the upside. So 25, what is it? 25.40. Let's see, 25.40. So let's say $1.40 and 450, 460. So that's 320, and then sell a 18, 320 and $1. Let's just call it $1.50 because it's spread. You can kind of get it tighter. 320, $1.50 to $1.70. So I can buy the 25.40 to 25.40 for $1.70, but I got to get long the stock at 18.
I see.
Okay. So generally you like to do this when the stocks, days when the stocks are down. So if the stocks end up down today or they start moving lower, these work when the volatility gets pretty high, the wings get bid up, meaning the puts get bid up and the outside wings get bid up. And, you could sort of do this call spread and you're going to pay more for the at the money, but you get a lot back on these wings.
Right.
So these are trades that I think are valuable. They're risk reducing. They are risk reducing trades, but they work. The key thing is that it's like being long the stock. So it's a commitment of capital. It's like being long a stock. It's just a different way using options. That's the key difference. It's almost like not really option. You're using options, but it's going to you're playing the game as if you're getting long stock.
I see.
Okay.
Right. Okay.
So that's something that is, keep in your arsenal, and when you're looking at it, you can always do those types of trades. It's sort of like saying Apple is probably not going to go break through the 145, 150 in the next 3-4 months. It might, but if it does, you'd be happy sort of just taking some money out of that, laying down $600 and taking out of it a couple of thousand. That's how you have to think about it. And if it's not, and it falls down 15%, 12.5%, then you're long, but you were able to get the upside. You were able to get the upside without taking that hit on that first 10%, call it. And that's big in Apple, right? That's why I say on the thicker stocks like in Apple, it's already down 25%. Well, what if I told you, all right, well, you can get long Apple 35% from the highs, 37%. That sounds exciting. It sounds like, yeah, I'd like to do that. And if I'm wrong and it doesn't actually, I don't get the chance to buy it there, at least if it goes up, I actually have a play on.
I see.
That's the logic.
Nice.
That's the logic.
I like
okay?
it. I like it. Great.
All right, good.
Cool. All right. Thank you.
Let's
move on to some more UA. Yeah. We got Dropbox.
Okay, good.
Dropbox. Before looking into Dropbox, guys, make sure you like the video. We appreciate you, and subscribe if you haven't.
Dropbox. Yes. I do see. Okay, so this traded well the last couple of days. I've been watching. We're long Aprils. Been there for a while. It looks like they're buying some Aprils here. So curious to see what they're buying. The 26s. I mean, we're in here, the 22s. So 26s, huh?
I mean,
30s.
Even
the 30s.
Right. I think I was looking at March 19th as well.
March 19th? Oh, wow. Next week.
Right. That's what I was confused about it. Look at that 26. Yeah.
That's no cash. Dropbox. So they made an announcement to buy Dropbox. They made a DocSend announcement to buy yesterday.
Oh, wow.
So the 26 bucks. Wow. This is a buy. Volatility is going up all day. Shot up here. Yep. I'm looking at this over here. Yeah. All right. So it looks like they bought it. 26,000. They bought it, and I guess they're still buying it all day, but the volatility is kind of normalizing a little bit here. So they're buying next week calls. Look, this is always rumored to be something where there's a buyout or there's rumors pop up. Maybe somebody's setting up for something like that, buying these like this. And let's see, the 25s doing it here as well. It's odd to buy 1 week options, 10-day options in Dropbox, after they've announced acquiring somebody, unless I don't know. I would say it's interesting. I like seeing it. The to buy the 26 is at 46 cents, for 1 week. I mean, 29, 28, so 28 and a half, call it. 28 and a half. How's it going to get to 28 and a half? How is Dropbox going to get to 28 and a half in the next 10 days without something coming out, some news coming out that is would make it explode a little bit? And maybe it's someone setting up for a rumor or something, but it looks interesting. I don't know why somebody would come and do that. Why not April's? Why not try to get the next earnings cycle? You got 21.75. It's clearly up against this. Maybe in the morning it opened up 24.75, traded up here, and then quickly came off. So you got this resistance here. It's going to need something in the next 10 days, but somebody thinks that will happen. It's interesting. It's interesting. I always say this is to me, this would be a great one for Google. I think, the CRM is taking out Slack, WRK, and I think Google, it's a drop in the bucket for Google. So I don't know what they're doing. I don't know why we're not seeing more of these bigger deals from the Microsoft, Apples, and other players. But I suspect before this this bull market is over, usually the bull market's over with these big transformational deals. So this is DBX is right on my list of names that could get bought out, that would benefit the bigger players like a Google. And yeah, so I would say Dropbox. I like it. I don't know why March next week. It's a little odd, but we'll find out. I'm sure. Right. I'm sure we'll find out.
Yeah,
I'm sure we'll find out. Nice. What's another one here?
Another one was one I stumbled upon by accident. GSX.
GSX.
It's actually puts
fraud. GSX is a fraud name. Fraud. It's a name. GSX has been a name that it's who was in this. Melvin Capital was in GSX, and Maple Lane, and there was potential fraud back in Look at just GSX here. Here, I think it was here. Yeah, there was fraud being talked about here. You see this large this large volume here?
Mm-hmm.
Yeah. So I think I'm not sure if it was Citron or Hildenberg research. So one of these short research people put out an article saying that or maybe it was Carson Block, which is Muddy Waters. They put out, I think it might have been Muddy Waters. They put out basically a fraud on this name. It traded well and then eventually just exploded. It exploded once. It came back again here through 140, 115. It then collapsed, and Maple Lane and Melvin Capital had a lot of puts in this name. And then you see what happened here when GME got active and started trading way up. The shorts came in and pushed. These guys had to get out of their positions. It was a pretty significant position in GSX. And again, this should show you how difficult it is to catch a fraud. Even if you know it's a fraud, how difficult it is to actually make a lot of money in these things, even when you know it. So, these are a short squeeze here. Okay, down. Okay, the shorts, here's the mountain, comes down. It comes back to this level here, and the shorts are getting aggressive. They beat it down here. I think there was an earnings there, and then it trades down. And it looks like it's going to zero, and then GME happens, and they get caught in that squeeze plus this squeeze. Same thing. Again, a second mountain higher than the first, right? Comes down sharply, goes back to, some level here where the shorts are, after this move, the short's going to start getting aggressive on the bounce, and it starts moving down, and now that looks like they're coming through. So what are they buying?
April 1st.
So let's just April 1st, or let's just say, I mean, this could easily, people think this is a zero. So it's fraud. They think it's a zero. But looking at the technicals, I would say 45 is a good target. 45, a break of 70. That's what I would be looking at here. And by the way, I'm sort of, when I look at something like this, to me, all this doesn't matter anymore. This takes on a whole new life here. So I'm looking at the levels that make sense to me here, as opposed to, drawing the conclusions from here, because this is a mess. This is a mess, and then this is another mess. It's all over the place. These are potentially investors have gotten out here. They got out here. They got out here. They're bailing. Then it shoots up. The shorts get squeezed. So to me, I try to think of this as a new animal here. And we have this large move. This is clearly 45 is a level that we're going to look for. And 70 for some reason came down here. 70 is a level here, and also this 81. So, these are levels. They're obviously very wide, and break 70, you could see 45. So what are they buying?
April 1st, 70 puts, and they're targeting $50.
70.
First, not 60.
Sorry.
Yeah.
April 1st.
Yeah, that's what I went to at first, and then I found this one.
Yeah, April 1st. That's interesting. April 1st. Like why trade. April 1st? Hold on one second. It's taking me a little bit of time here. Here we go.
There it is.
Okay. Okay. It's only $1,500. It's $500,000. It's not a ton, but it is like a bullet that someone used here. Premium. It's on the bid side here. I'm trying to. The IV is down, so it was 100. This traded 300. I'm not convinced it was a buy, to be honest. I just don't have enough data to be convinced it was a buy, but I do see that they are trading the puts on these things. Stock is down $8. It's probably a buy. I don't think people would want to sell puts on this name, and the stock looks off. The stock looks awful. I mean, this is just, it's not a healthy stock. This move, like, it's just not a healthy stock. So 115 to 70 is 45, 45 less 95 is $40. So this is a disaster. Okay, this should shoot up here to 115, down to 70, back to 95. This is a washing machine. It's trying to take people out here and go to. It's basically, this is what it does to go to zero. It's like somebody, you know, kicking and screaming that they don't want to go to the bottom of the ocean for, you know, I'm watching too much Dexter in the last week and a half. But basically it's somebody kicking and screaming saying, yeah, I don't want to go to zero. You know, it's like doing everything they can to fight their way out. But, you know, the shorts are still pressing here. So I would say this is, I like the trade. I like the trade. I'm not sure it's enough to make me get super, super excited. And it's really, I just know that it's really, really hard to catch these stupid things. But when they collapse, it just collapses. It's literally, it's 80 and then it's 30. And you think to yourself, why didn't I just buy those for $2? But you could have done that for the whole year. And let me tell you, you're spending $5, $7 each month to try to get these things. So it's very, very difficult. Very, very difficult. Let's go to, what else we got? Let's go to the next one.
Let's go to ET. ET, a lot of volume there, yeah.
Okay, let's see here. ET is a name we've been looking at for a while, right? Yep. It's hanging. It's a single digit midget. Let's see here. Single digit midget. Let's go. Let's see here. All right, so pressing up against. Let's go a little further. This is an MLP type of name. It has a big dividend. Let's see. Just go back a little bit. I just want to see again where this. Okay. All right. So let's just take a quick look here. I'm going to say, just eyeballing it, 9.5, 14, and then we got something going on right here where we're almost at, and then this is obviously we're here. Okay. So yeah, I mean, they've been trading the 8s, the 9s, the 10s for a while now. I think they started basically back here. I think when they first started hearing this name in late December, early January. Buying calls, they've been right here. What are they buying now? Probably 8s, 9s, and 10s.
Yes, 8, 9s, and 10s mostly. Yep.
I saw this. They just keep coming back to this name. So the open interest, yes, these are all bought before the 9s. Is this a spread here?
I don't think so, no.
Wow. These are the Aprils. They're buying the April 9s. So clearly looking for a breakout here. I mean, if you get good, it's leveraged to oil. I mean, ET, I would say, is leveraged to oil. If I remember correctly, they were lowering their costs. There's a deal going on in the name. There's a lot going on in ET. They have a high dividend. They're trying to reduce costs. They're leveraged to oil, and they have a deal going on. And you know, if you like a dividend stock with potential gains, I guess this is the type of name that you're going to get in. I don't know the details in especially in the oil business. I'm sure where's Rudy here? Rudy could tell us what's going on in the oils, but I see what they're doing here, but I just, maybe there's a different way to play this. You know, they're buying April, they're pushing the Aprils up a little bit as far as volatility. Like, why not get, unless there's some sort of announcement that I don't see, why not get, so earnings 510, so in May, 9s. Just seems like they're paying an awful lot for these calls here. They're buying 50,000 of these things. They're paying 18 cents on these things. They started the day at 10 cents, and now they're paying 18 cents, 20 cents, 19, 18 cents. You know what? I would sell them those 19, 20 cents if I can buy. I'd sell them at 18 cents here. So it's like almost like leave an offer out at 18 cents. It's the 10 strike calls for the next 5 weeks. So I'll sell you those at 18 cents if I can buy the Julys. If I can buy the July 9s at like 80 cents and sell those at 18 cents, that gets me about 63 cents. So I'll pay 63 cents for the 9 calls, but I get July, I get the earnings. There is a dividend in there too, which is probably a decent chunk. 10 cents. It's not going to mean anything if the stock flies, but you know, I would say that's not a terrible trade. But paying like 80 cents, selling the other one at 18 cents, call it 62 cents. So 62 cents for the 9, 10. If it blows through 10, right, and it goes straight through 10, which I think it'll take a little bit of time to get through 10. But if it goes through 10, then 62 cents turns into basically a little bit more than $1. So I would make almost 100%, right? So I would make almost 100%. If I can get through the next 4 weeks, in ET, then these are going to go to zero. The 10s will go to zero that they're buying today. These at 18, 19, I would just be on the offer if they want to take them. They would go to zero. So I would keep that and I would stay long the Julys for the earnings and for a little bit more time. So that's something. I think they're paying too much for the Aprils today, whatever they're doing, whoever's doing that. So that's something to think about. Pay 80 cents, sell those at 18 cents. That's 62 cents. If the stock, you're basically long the 9 calls in July with a little bit of a tricky situation where it doesn't get through $10 by April. Okay, so it gets through $10 by April, you're still going to make 100% or close to 100%, but you're not going to make 300% if it goes to 13. So you're sort of capping yourself out there. But I think giving what's today? March 10th. Today, March 10th. So you're talking about 5 weeks. 5 weeks for this to move up $1.60, which is 20%, without anything that I see happening in the market besides a potential breakout, potential this level right here. I think that's probably a better trade if you want to be long ET. That's what I would say. That's my best guess. It just seems a lot to be paying for the April 10s.
Right.
Even though it's 19 cents, it's still 19 cents is still a decent amount. It's like you don't want to throw it away. It's still 19 cents. And you're going to buy more contracts. So remember, when you think about 19 cents, you can't think about 19 cents. You got to think about a position size of mine is going to be $1,000. Whether you're buying 19 cents or a $2 option, it's still going to be $1,000. So you can't, it's not cheap just because it's 19 cents. Just remember that. You got to be very careful in that thinking.
Yeah. Just like penny stocks kind of.
Exactly. What else you got here?
I got a question now. Today I ran into these. I never heard of them before. They're called something like 3X leveraged ETFs of SPY. I saw one. It was called SPX Sell. So I'm thinking, like, if I can make 3 times more money,
So rewind. Okay. Make pretend you never saw those, and keep moving on. No. So yeah. I mean, look, they created these 3X leverage ETFs. And they're very, very addicting. They trade up and down. I mean, I wouldn't trade out. First of all, they're 3 times the regular asset. And then if you trade options on 3 times the regular asset, it's like crazy fast. Okay. The bid offer on the options are too much really to actually trade them well. So I would just simply say, don't do it. Don't trade the options. If you wanted to play these 3X names, then you could play them. Try not to play them for longer than 3-4 days. It's not like something where you can buy the SPXL and just hold it for the next year, 2 years. These things, this is a good lesson. These 3X leverage options, they are designed, very important, they're designed to go to zero. Okay, so over time, they will go to zero. Okay, so why do I say that? Why do they? Because of the 3X, because of the way they give you 3X, when the stock goes up, at the end of the day, they have to buy the hedge to give you, to make sure that they have enough money in the ETF to make it worth 3X or whatever it is. So they have to buy if the stock goes up. If the stock goes down, if the market goes down in SPXL, they actually have to sell. So they're buying high, selling low every single day forever. Ultimately, that money runs out. Okay. When it's highly volatile, they are actually losing that money a lot faster because they're buying much higher, they're selling much lower, they're buying much higher, they're selling much lower. So what happened in the last 3 weeks, these 3X leverages lost a lot of money. So for example, if you bought it at 100 and then it did this, the asset is here and it goes up and down like this a lot over the course of 2 weeks, at the end, the asset might be the same price. So it went from 385 to, up and down, but ended up at 385. But the SPXL, you bought it at 100, might actually be like 94. Even though the asset's at the same price, that ETF, 3X ETF, is down 5-6% because you got chopped up because it's buying high, selling low. So they are designed to go to zero. So someone who is just holding on to these 3X for the long term, it doesn't matter what happens. It's like ultimately you can get really chopped up and they can go down a very significant amount. So it's percentage based too. So I would be careful with them. I would be careful. Okay. Now, somebody might say, well, then I can buy puts. And yes, they do go down over time, but, it's over time and catching that is difficult. And they charge you, the puts have an embedded, it's a mechanism. They have an embedded higher implied volatility that's taken into account all this stuff. Okay, so there's a lot going on in these names that people don't understand. But I would say that it's probably, you want leverage, you're getting leverage through options. That's more than enough leverage any beginner should use. And frankly, the bid offer on these things with the options is just not something that you want to be trading around, and it's moving so fast. So I would try to avoid 3X leverage ETF options for sure. And if you wanted to do that, if that's your game and you wanted to make a little bit of money, you have a strong opinion on something and say, you know what, I'll just trade this. Understand that it does also move very quickly. It's hard to catch the 3X leverage, but also you don't want to be in it too long. They're designed to go down over time.
Okay.
All right.
Thanks.
Good.
Nice.
What else?
Next one I have for you is Facebook. Actually, we've been looking at it for the past 3 days, and I'm seeing calls being bought in spreads. So
again, Facebook.
Yeah.
Look,
I
mean, I think there's something here. I think that Facebook is a name. Just looking at Tesla here. Look, Facebook is a name that, again, we keep saying it's somewhat cheap. It's in this range that is not. It's stuck until it gets out of this range. It's stuck. So you got this here. This is a weekly here, and you got this flag. It's fairly. You're looking at this sort of range here. You have this significant move from the lows here. A lot of bouncing around. You have antitrust issues. I think people trying to set up for a breakout. If the market decides it wants to go up, a breakout above 280 is going to get you. Like if this breaks out to the upside on good volume, it's going to, call it 330, 340, in my opinion. I would say first stop is 300, but it's going to start making a significant move. So to break out of this to the upside, it's just going to take either a great earnings report. It's going to take Zuckerberg saying something. Maybe it's a takeout of something that's accretive to them, or a great asset. Maybe, the antitrust doesn't go through and they make a statement saying that, no, it's fine. And we're going to let these things live, even though it's not really going that way, because Biden is just putting in place a couple of people that aren't very positive, leaning positive towards these. They're not leaning positive towards these tech companies, big tech. But, I think people are saying, look, it's a cheap stock and they had great earnings. There is some hair on it. They're not valuing WhatsApp. They have cash, 10% in cash. The multiple on the stock is, probably in the high teens. And within the end of the year with earnings, you'll see that the multiple gets down to like 16, 17. At some point, it's dirt cheap if they don't get this huge antitrust, the government's position against them. So can it go here? If it breaks out, it's going. Now, what are they buying? That's my 2-minute rant.
May 280s, 320s.
Okay, 5. Yeah, so there you go. So that's exactly that's exactly the way we're looking at it, right? 280, 320, which is, they keep doing it. I mean, I see them every other day. They're coming in 280, 300. Now they're doing this call spread 280, 320 in June, and you get the earnings. Yes, May, April 28th. So you get the earnings at the end of next month. They have the mace. They're set up for a potential breakout. They're going to pay $8.50, maybe $8.50 to make potential 40 is the max. So 840 minus 850, 3150. So 3150 divided by 8.5. Call it 3.7. So almost 400%, 3.7 times your money on that trade. That's what they're looking for, right? That's sort of us saying, the guy thinks it's 50-50, maybe better than 50-50 that Facebook actually breaks out on the next earnings or does, has a strong showing. And if it breaks out, it's going to run. And that's him making his bet saying, you know what, I'll just watch it and I'll watch the earnings. And that's my bet. Maybe he'll add to it. Maybe it's the same guy who's been in it already, right? Who's there. They've been lining up for these types of trades, which I think makes sense. Especially if they have a sense of, we talked about who's buying. The big buyers are like some of these guys are value investors that are buying Facebook. So they plan on being long Facebook for the next 10 years. That's what a value investors. The guy's going to be long forever. So they're buying it because they see it as a cheap stock. What's going to make it become this go stock? Someone is playing a breakout and then people jumping into it.
Okay, cool, nice,
good.
Yep.
Good.
Yep.
Any other questions?
No, let's first highlight one from Brenda, which I really liked, and we missed that one. DKNG. Take a look at August.
DKNG. Oh, I know it well.
Taken aback when I saw this one.
DKNG. August.
Yes, and she also asked a question after you look at it.
Yeah.
She asked if it was worth. Which one was it? Yeah, there it is. She was thinking about playing. Not thinking about, but just saying. What about a 85.90 put call spread?
85.90 call spread. So here's the thing about call spreads that you got to be careful. Aesthetically, it might look good. So say you pay $7.40 and you sell it at $6.20. Let's just say that's $1. What is that? $1.20, right? So say you pay $1.20 for the 85.90. Let's say DraftKings zooms up to 85 tomorrow. Where is that 85.90 call spread? I don't even have to look. It's probably around $2.50, right? If it goes to 95, where's that 85.90 call spread going to be? If it does that in the next 3 weeks, it's probably 275. If it goes to 80, where's it going to be? It's probably 2.25. So what happens is because it's a 5-point spread and it's tight, it has to get really outside the range, like maybe at 100, for it to get out of that 2.25, 275 range. So the real trade is you're betting $1.25. Really, the max it's going to be able to make until, let's call it May, June, is $1.25. $1.25 to make it $1.25. I don't really like that, because if the stock starts going to 80, 85, I'd rather just, it's probably breaking out. There's probably obviously a lot of great news. They price it pretty well, frankly. I mean, they're saying 115, so 80, 85 is not out of the realm here. The market's saying by August this could be $120 stock, $115, $120 stock. So I would say if they're looking at the 90s, we're sort of looking at 130. Nice. It's a little high here, so because of the volatility is a little high and it's a little bit higher, I would go down to say maybe, let's call it 300% would get me on the 90s. So that's 115. So maybe about 115 to 120. It's probably a little bit more likely where they're thinking, 115 to 120. So, I don't particularly like doing call spreads 5 points wide for $1.20, because the max, if you're really right, the max you're going to make is $1.20 for a while until time decays from a lot of the options. The reason being is because, just to give you an idea of how options work, if Brenda, if the stock goes from 16.8 3/4 to 105, the question is, how much would the 90, what are we looking at, 85, how much would the 90.85 put spread be? The 90.85 put spread. The 90.85 put spread would probably be around $2 if the stock was 100, right? A buck 75. So $1.75, $2. Then the call spread, 85.90 call spread you have would only be 3 1/4, 250, 3 1/4, right around there. You see that? You see what I'm saying here? So it just flips. You own the call spread. If the stock goes through the call spread all the way to 100, 105, then really what you own is the 90.85 put spread, right? And that's the value. That'll be the this what they call it a box. The 85.90 call spread and the 85.90 put spread has to equal $5. Less, maybe a little bit sometimes with maybe if there's a dividend or an interest, but it's about $5. So if this one's 2.5, then this one's 2.5. If this one's 3 1/4, this one's 175. If this one's 1, then this one is going to be 1 1/4, 3 4, 3 3/4, 1 1/4, 3 3/4. So that's how it works. So it's tough. I would not do it. I would try to find I would try to just find a wider, you can do call spreads. I would try to find a wider call spread, something that is, let's call it the 75.95 is $4. So if you like that if you get instead of August, you get the earnings in May, the 75.95 for, let's say 4 1/4, just say 4 1/4, 4 1/4 to make, let's just say 4 to make 16. So that's 4 to 1. So that's something that is interesting. If it goes up very quickly, and very quickly, I mean, it's going to hold through earnings. So the vol is going to get picked up. It's, you're going to pay 4 1/4. It'll probably won't be worth more than $8, $9, even if the stock went all the way up to 90. Okay. Because of earnings and you get the earnings on that date. So that's why these spreads, they aesthetically look good to jump in, but you'll quickly learn that it could handcuff you, and if you catch the big move, you're never really rewarded the way you want to be rewarded.
I see.
Unless you do what we did in the Apple, where you knock the cost down from $4 here to $1, then if you could do that in DraftKings, say, for example, let's just call that. Let's look at that trade. 75.95 is $4, 4 1/4, and then you sell the 55s at 275. So that's now $1.50. So you pay $1.50 for the 75.95, and then you sell the 55s. But you're long DraftKings. It goes to 50. You're going to be long 55. So it's like stock. But here, that $1.25 that you paid, $1.50 that you paid, if the stock goes from 75 to 90, is going to be worth, let's call it 15. It'll be worth around $9. 150 to 9, that's 7.5 on your $1.50. Then you can take that off, and then you could just say, okay, I want to take off the whole trade. You'd have to buy back your 60s at the time, or the 55s, but those are going to be at that point probably 50 to 75 cents. So net, you would make good money there, but you're not paying the 4 1/4. You got to sell something to do that, which takes off some of the leverage because you have to post up the capital. 85.90, I would not recommend. Basically, is a final answer.
Okay, and relating to this, let's look at this comment real quick.
This is a great question. Is it same or better to have more contracts of a smaller spread than one bigger spread? Well, I would say, first I would say this. A lot of times we're looking, especially in the ET that I just showed you. If you're going to buy one out, if you say your lot, this is a good question, because if you're going to buy an option, say you trade $1,000 per trade, it's $1,000 per trade, and you're going to buy the option costs $3.33, so you can buy 3 lots. So you buy your 3 lots, and that's one answer. You're long the 3 lots. Or you could do some spread where it's like $1.60 or $1.66, right? Half. And then you say, well, on the spreads, I can buy 2 times the amount of the spreads. What I tell people is, you're not fooling anybody. You're really just getting more leveraged on the same thing. Your stop is going to be still $1.66, 50%. And that stop is going to be about 83 cents. What I try to tell people is do the same dollar amount. I'm sorry, do the same contract amount, just do it in spreads. That way, and especially when you have time spreads, because when one goes away, you will have the same contracts, 3, that you would have had, without doing the spread. So it's about trying. It's when you do the spread, you're trying to lower the cost. But if you lower the cost and raise the leverage, it's like you're almost getting back to the same place. You're trying to reduce the leverage, reduce the cost, and still have a very similar type of bet. So I would not go. I would, on the one hand, you can buy 3 lots, or you do a spread that costs 167 and you can buy 6 lots. I wouldn't buy the 6 lots. I would actually just stick with the 3 lots. You're fine. That's the game you're playing. You're playing, and you're using a spread to sort of lower the cost. If you buy the 6, you're simply it's just a leverage position, and it's actually you're playing a bigger. You're starting to play a bigger game, more contracts, bigger game. So I would just stick to the 3. If you're doing spreads, now this was talking about spreads. So if you're doing one spread and you're saying, oh, well, I can move way out of the money, that doesn't make it cheaper. Remember, the whole point that I'm trying to teach you is that just because something costs, one spread here costs 50 cents and this spread over here costs 80 cents, that doesn't mean the 50 cents is cheaper or better. That just means it costs cheaper is not the term we should be using. It costs less money, but it doesn't mean cheaper. Cheaper doesn't mean, it doesn't mean that it's better. Cheaper generally means better. And, you go to a supermarket, an apple costs $1 here. You go over here, it costs 50 cents. Same apple coming from the same place. This one's cheaper. I like it. I'm going to buy this one. In options, you have to look at the risk reward of the structure. You have to look at the risk reward of the call. A 20-cent call in Apple, something that costs 20 cents, way out of the money, costs 20 cents versus the one that costs $8. The 20 cents is costs less money, but it's not cheaper. It actually may be more expensive than the $8 option, depending on your risk reward and depending how you're looking at it. That's what the options chain is trying to do for you. So I built the options chain so you don't fall into those traps where I always want to buy the out of the money option, because the way out of the money option, because they're cheaper. I can get 20 of them or 30 of them for 20 cents as opposed to getting one lot for $6. That doesn't make it cheaper. In fact, you might be buying the most expensive option on the board, even though it costs 20 cents.
Right.
Okay. So it's very, very important concept to understand. We go through this in 3 steps a lot and trying to help people understand that you can't look at it this way. This is not the way to look at it. This is the wrong way to look at it. There's nothing wrong with buying way out of the money options if you think you're going to score and if you think the risk reward is in your favor. There's nothing wrong with that. I can't argue with someone saying it's an option. It's yes, it's out of the money. I would try to advise you to bring it lower. But if you're telling me, no, I think it's going to shoot to the moon or do this, then okay, you have the right reasoning to buy that one, because in order to buy that one, you need a skyrocketing move. But they're happening here. So, you just need the reasoning behind it. If you give me good reasoning, I have no problem. Any option on the board could be the right option. It needs the right thought process. And again, that's what we're teaching at 3 steps.
Nice. Great. Cool.
Is that it?
Yeah.
1 minute. I give you one more question. Okay. 1 minute.
Let's get Mark in here.
Let's see.
It's
Mark,
related.
what do you got here? Let's see. On this vein, does the price have to be over the range of the spread to maximize the profitability? But you selling a call cheaper, and the closer you get to that strike, the more it will cost to cut. Does the price have to be over the range of the spread to maximize the profitability? But you selling a call cheaper, and the closer you get to that strike, the more it will cost to cut. I'm not sure I understand the question. So if you're looking at a call spread, are you trying to get your target stock price over the higher spread, higher strike? Does it have to go above? In general, yes, you'd want it to go as high as you can. And frankly, maybe we'll save this for tomorrow. What we're looking at and what we're comparing is what would you pay for the outright call, and what would you pay for the call spread? And then your target stock price is going to dictate which is better than the other. Okay. Maybe tomorrow we'll have an actual number ones to show that. But yes, in general, I would say I like my highest strike, as high as possible above my target stock price, and still have what I think a good good risk reward, because I know that as the stock zooms or goes to that higher strike, I get handcuffed. I don't like spreads because I get handcuffed. You saw it with the put spreads. What happened? You were saying to me, when the market went down to 372, we were short the 370s. And you were saying, man, they're expensive. We both looked at them and said they're expensive. But you have the other ones, and you got, so we were, to some extent, you get handcuffed. Now, you still made 200%. And by the way, you would have to look at the other, when we bought the 390s, the 390 puts were about 650 at the time. Mm-hmm. And 650, when the stock was 372, they would have only been worth, let's call it $18.50. Okay, so 650 to 18 is about 12. It's not even 200%. So the put spreads actually were the better trade than the actual puts that time. But it's going to depend on when you think it's going to happen, how you think it's going to happen. Though that spread could handcuff you. Mm-hmm. We thought, oh, this is a good spread because you can make 300. Let's call it, what do we have it at? Almost 400%. But I know realistically, if you can make 250% on that trade, that's about as most as you're going to make from that put spread. You always, whatever aesthetically you see on the put spread, you say, oh, I can make 5 times my money here, 500%. Realistically, your max is going to be about 300%. Mm-hmm. Because you're never going to get that whole thing. It's very difficult, not never, but it's very, very difficult to get the whole spread, the whole strike difference. Right. Okay. So that's why if I see that I need more time in the SPYs and I can't get, I didn't think the SPYs was going to go down to 350. Okay. So I'm going to do a put spread, but knowing that if I can get out at 200, 250, I'm okay with that. I'm cool with that. All right.
Okay.
Great. All right. Cool. Awesome. We will see you tomorrow.
Yes. Thank you, Felix. Thank you, everybody. Don't forget to like, subscribe. We'll see you tomorrow.